Let's start with some definition of some terms. The first term you need to be familiar with is profit. Profit is revenue, which is your sales, minus expenses. The second term would be expenses. Now there's two kinds. The first is cost of goods sold, which are your costs directly related to the production of goods and services, for example, your direct labor and materials. And the second would be your operating expenses. And these are expenses not directly related to the production of goods and services, such as office supplies, insurance, and property tax. Then there's profit margin. There's really two types. One is called gross profit margin, sometimes called profit margin. It's equal to revenue minus COGS divided by revenue. And then the last term is net profit margin. This differs from gross profit margin in that it accounts for OPEX. So the equation is revenue minus COGS minus OPEX divided by revenue. After you've adjusted your budget so that now revenues are greater than expenses, you want to determine your profit margin. Profit margin is typically expressed as a percentage, so you take your revenue minus your cost of goods sold, that quantity, divided by the revenue, and then multiply it times 100. So why do you want to determine the profit margin before you release the budget? Because many companies have a minimum profit margin that you have to achieve, so you want to analyze your budget to make sure you're meeting this number before you release it. It's also a good idea to compare your profit margin to the industry standard before you release your budget, as this will give you a good idea of whether your revenue or cost of goods sold are in the ballpark of your industry sector. You can also use profit margin to compare profitability between two products. We've done that here using product A and B. Our revenue are shown, our cost of goods are here, and then we've calculated the profit margin. You can see that product A is more profitable than product B.
By the way, though product A is more profitable than product B, I like product B better because it adds more money to the bottom line.
I absolutely agree with you. If you take a look at product A, it adds $50,000 to the bottom line, or product B adds $70,000 to the bottom line. I also like product B better. However, that said, it's important to realize that every time we sell product B at the expense of product A, we lose 3% profitability. Aside from gross profit margin, there's also net profit margin, and this is actually a better indicator of your overall profitability. The reason is because it factors in OPEX. The equation for net profit margin is revenue minus COGS minus OPEX, that quantity divided by revenue, then times 100 so it becomes a percentage. Now if we go back and take a look at product A and product B, and we use those same revenue numbers and COGS numbers we had before, but we factor in an OPEX of $10,000, our net profit margin on those two becomes the same. Now in our prior example, as is usually the case, different products have different margins, but margins may also vary by sales volume. So what you really want to do is chart your product margins at various sales volumes so you can see how the effects of OPEX are kicking in. Here's our chart for products A and B. We've charted revenue, COGS, OPEX, profit, gross profit margin, and net profit margin. We also graphed it. Now in our example, gross profit margin is the same at all points of sale for each product because COGS as a percentage of revenue is a constant. OPEX is the same at each sales volume, but you'll note that there's an increase at the 150,000 revenue point. Now obviously the point of having a business is to make a profit, and profit is equal to revenue minus COGS minus OPEX, so we always want to maximize profit. Now the first thing that we see here is that the net margin offset remains constant at all sales volumes between product B and product A. And that makes sense because everything has OPEX, for example, is shifting the same at each sales volume, and COGS as a percentage of revenue remained a constant. And since product A always had a 3% higher margin than product B, that 3% translates to every single sales volume. Now what that translates into is that any one-for-one sale of product B at the expense of product A costs us 3% profit. We mentioned that earlier. So we might start to draw a conclusion that, hey, we're always going to prefer to produce product A because it's always more profitable than product B at the same volume. Hold that thought, we'll come right back to it. Now what we're advocating is that the control of OPEX as a percentage of revenue is key to increasing your overall profitability. Sure, control of COGS is important, but OPEX usually can be modulated easier. To see the sensitivity that OPEX can play, take a look at the prior example. In the prior example, product B at 150,000 revenue had a $10,000 of operating expenses. This made net profit margin 40% instead of the 37% we're showing now at a $15,000 OPEX. Now that we've charted revenue, expenses, profit, and profit margins, and then graphed them, we can see that there's a knee in our profitability curve. What this means is that OPEX is varying by sales volume. Therefore, our optimum profit is sales mix dependent. Knowing about the knee tells us that we need to move beyond it. However, if we're stuck there, for example, with product A, and we can move product B a little bit beyond it, we can obtain the same profit margin for product B at $200,000 as we're achieving for product A between $100,000 and $150,000. And our last observation is note the slight decrease in the graph for product B net profit margin between the $100,000 and $150,000 point. This isn't reflected in our chart because we rounded up to get rid of the decimal points. But you can see it in the graph, and it would be worth exploring, and clearly you would not want to operate in this range for product B for very long if you could help it. Now you may be asking, is there a way to compare profit to sales volume? And the answer is yes, but you need to use a different margin, and that's called the contribution margin. We have a lesson dedicated towards this. To continue your learning, check out our lessons on contribution margin analysis, life cycle cost analysis, payback analysis, present value and net present value analysis, and then we have an entire series on budget monitoring. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.